Hey, hello everyone. I am Chris from Elliott Wave Cafe. Welcome to my YouTube channel. Today we're going to talk about the S&P 500. I've asked Twitter, I think on Friday, what type of bearish count would make sense at the moment. We've had, several weeks here of, pretty downside price action in the S&P 500 since, pretty much the end of July. The markets have enjoyed a, very nice run for about, let's say, a little bit less than a year. So from October 13th of 2022 all the way up here to July 2023. And since then, we've been coming down. And, there's a lot of debate out there in the kind of on the FinTwit, on the financial media, in the Elliott Wave community about, what makes sense and what's the likely path of this index to move. Now, of course, the market is not just the S&P 500. You have the Dow Jones, you have the Nasdaq, you got the Russell, small caps, value, growth. There's all kind of areas of the market that are not necessarily suffering all the same. And there are different reasons to believe that bulls could be right or bears could be right. So this is kind of what makes a market. But for today, I wanted to just kind of run you through what I think about the S&P 500. I don't think I've done a video on this in a while. I write a daily drip sort of newsletter with updates that you can find it on my Substack, and check out the link. It's right below the video. You'll see that, and you can kind of see the latest thoughts that I have on the market. But going back to the S&P 500, if we can start with just a simple naked chart, the biggest debate, I think, or one of the debates that we have, at least in the Elliott Wave community, is kind of what is this decline from this top to this bottom, right? And there is a lot of biases in the market, right? A lot of traders think and look at the fundamental data, try to combine that with the technical and Elliott Wave, and create a view about the market. So then they choose to, count this in a certain way. Then the bulls have a certain narrative, and then they choose to count this in a separate way, right? And there's a lot of debate about kind of how this happens. And the reason why this is important is because this kind of leads to what could happen next in this move in the S&P 500, and actually, what can happen in the future. Now, there are several ways to kind of look at corrections, but another thing that kind of got thrown in the in the mix lately is the fact that we've had a pretty strong rally, and this rally here went over 61.8 retracement of this decline. It went over 78.6, right? So, the bears felt a little bit of pressure here, but then we stopped at about 88.7, very close to 90%. And this creates another narrative. Hey, what if this whole thing is a flat formation, right? What if this is, let's say, a three-wave decline, because flats are 335, so you have a three-wave here, you got a three-wave here, and now you're getting ready for a five-wave decline. Well, what if this is a five-wave move, right? Then you have a three-wave rally, but it is so high. How come zigzags, because zigzags don't usually travel that high. They usually stop at about 38.50, maybe a 61.8%, but rarely they travel all the way up to almost 90% of the previous leg. So you can see why there's just so much debate and so much arguments on Twitter and other places about, and I'm sure chat rooms and newsletters and stuff like that about what's the direction of the S&P 500. So here is a couple of things that I think are happening now. If you look from the top to the bottom in here, in my view, by doing Elliott Wave here for a little while, it's that this move in here, it's it comes down in one wave, it goes back up in another wave, comes back down. So you have two large corrections that are happening in this sequence, right? So for all intents and purposes, you have plenty of reasons to say that this is a 1, 2, 3, 4, 5, and this is, since you have a lot of overlap, that it's some kind of a leading diagonal. there are arguments, obviously, because this latest decline, it's a bit shorter than this one, and in expanding leading diagonals, wave 5 is supposed to be longer than wave 3. Now, Ralph Ellison Elliott never really picked up diagonals in his studies, and did not offer guidance on that or anything. So, this is more of a more of a modern look at wave counting when you have overlaps, and it's not super precise, and I would not, let's say, beat anyone over the head if you have a fifth wave that's a bit shorter than a wave 3 and be such a, stickler for perfection on that, right? Because you can clearly see that the market moves in here in arguably what it is, a 5 wave decline. Now, if that's the case, this could be part of a flat, but it's not, right? You don't have a nowhere near an ABC move to create a 3 wave move to new highs, right? So sure, if you think this is a 5 wave move, kind of coming down, and then you have this rally, that means that you got to have a C wave that it's at least proportionate with this decline in here, right? So you have an A, let's say you get a long B, that's a zigzag, right? Because anything that starts with the 5 wave, it's a zigzag. You go up in B and then you sell down in C, which, if you look equally, probably takes this market just visually to about 3,200, 3,250, or maybe even 3,000, right? So let's look at that. Let's just kind of see how that looks, and I'm going to put this on here now. So let's say that this is a wave 1 top, and you can argue again that this is maybe a wave 5, and I have something to show you on that. So that's kind of how the leading diagonal will look, that you have a wave 1, 2, then you go with 3, 4, and 5. So 1, 2, 3, 4, 5, fine. You go up in 3 waves again. This is a little debatable because you got this kind of long pullback right here. So probably, the whole thing a 3rd wave. Then you go again, sharp move in a wave 4. You overlap wave 1, 1, 2, 3, 4, 5 for A. So you finish a 5-wave decline. Now you go up in an impulse. You do, probably a flat right here, right? Because this moves to new highs. And then, you have a little awkward looking kind of C wave in here. And you go up to close to 88.7. Here is what's interesting. If you look at this B wave, it's equal not only in, actually in time, it's equal in time with the wave A. Wave A, this wave right here, took about 195 bars to complete. This is the distance that it traveled from this top to this low, January 3rd, roughly, to about October 12th. And then this thing from October 12th to about July 26th, it's about 196 bars, right? So you have, just about a day or so more in this B wave, right? Fascinating how exact these waves are moving. Now, if you're just assuming that wave C would be equal in time with, let's say, wave A in here, that would take you all the way out to about April 29, April 30 on this decline. Now, here is what bears need to happen here. What needs to happen, if this is the right interpretation, they need this, and that's what I was asking Twitter what this is. They need this to be a 1, 2, 1, 2. And I agree. Yeah, there is also the option of this becoming some kind of a leading diagonal, just like this guy is. But if you can see this decline, it's a bit longer than this. So you have a 1, 2. Let's say you got a 3 in here. You do a small 4, and then you do a 5. But the 5 cannot be very short. It needs to be somewhat, if not bigger than this decline, maybe close to that size when it's selling off in here, right? And that would create what we would be a leading diagonal in 5 waves. Then you would pull back in 3 waves and then sell back. Now, usually C waves are much sharper than wave A's when you have zigzags and even in flats, right? Those C waves are very, very rarely. I mean, it happens that wave A's are sharp, but most of the times it's the C waves that are the sharpest. So you almost have to go in a huge flush lower. You almost have to have like a massive market breakdown here for the 1, 2, 1, 2 to kind of work out. And for that, I'll take you over to what happened in 2008, 2009. So you can see in here, this is a C wave, right? Because you have the first decline, then you go up in this B wave, and then you sell down in wave C. So the market started in a 1, 2, 3, 4, 5, a very clean, undisputable 5 wave, then went up in a wave 2, and then it did another 1, 2. Right? So if you think that this is where we are in the sequence, in this 1, 2, 1, 2, that means that the next month, the next few weeks of this market, right, have to be, or a couple of months, they have to be very, very sharp. Coming into one of the strongest periods of the year, from the end of October to January, you would almost have to have this type of decline, this type of a collapse in the market. So you're fighting as a bear a little bit of the seasonality. Coming into the end of the year, you're also, I say, fighting an extreme sentiment. The fact that you're coming into, extremely well established support zones into the 4200 area, right? I mean, the markets spend a lot of time trying to break above these levels. They've tried here in the summer of 2022 before the next leg lower. They've tried here, failed numerous times. They spend numerous weeks in here, 6 or 7 weeks, trying to break this level. In the early spring of 2022, and then or 2023, and then we broke up through that 4200. We went all the way to 4600, and now we're coming back, and we lost the 4320, but we're coming back into this massive demand zone at about between 42 and 4100 right here. So going back to the counts, this is kind of what the bears are saying that needs to happen in here for this count to kind of work out, right? You have a 1, 2, 1, 2, and as we know, the third of a third in the Elliott wave decline, it's very, very sharp. So that's this wave right here. And it could be like this and like that, right? So, but it almost has to be vertically down. Now, this is just to, and I'm not saying, this is going to be perfect in terms of equality in time and all that, but, if it's not inequality in time, maybe it drags a bit longer in here, but then, it kind of changes the way this declines. Again, don't forget that we're also in a little bit of an uptrend in here, right? You are in a move higher, you're in the middle of this channel, you've been supported, right? So there is no actual, let's say, break of this, of this middle line here into the S&P 500. The other thing, that we're looking is for 100% equality in terms of decline. So that would come at about 33.38. That would coincide exactly with the bottom of this channel. But I mean, look at the move. This is how this needs to kind of happen. Okay, 1, 2, 1, 2, 3, 4, 5, 4, 5. Let's say that maybe this fourth wave, it's less. But first of all, we got to get there, right? And then you would kind of get up into these levels. Now let's play the argument that this is a flat correction, and you have, instead of this move here being a 5-wave move, you have it as a 3-wave move, and you're looking at this as a 1, 2, 3, 4, 5 for a wave A. Then you got a B and a C coming down, and then so that's a 3-wave move. And then you go, and some of you might count it as a WXY, although that's a bit more, maybe a bit more difficult. Then you go up in A, B, C. So you have a 3, 3, and then you have a 5-wave decline. So same theory, same story, flats versus zigzags, and you would almost have this whole decline need to happen. Now here is the difference a little bit in the flat. While in the zigzags, almost always you break below the wave A low, right? So kind of satisfy the requirement. Rarely you have, what we call like a truncated C wave, where you don't break below the wave, and wave C kind of stops short of that, and then you move back up higher. But in a flat formation, you don't necessarily have to do that. Now, because we haven't, with this B wave, we haven't gone up, this would qualify as a regular flat, right? And usually they come and test the previous A wave low. Sometimes they even break below that a little bit. And that would be, a 61.8 move would be at about 37.75 when you look at C kind of versus A. But you also have a C versus B if you want to look at that 61.8, 38.80. So you could have maybe, more of a shorter 5 wave decline in here, right? 1 2 1 2 3 4 5 4 5, and you're just, barely going, let's say, to about 3,800, 3,900 before you start to kind of reverse back to the upside and still satisfy that kind of flat formation, design, I should say, for the lack of a better word. So, long story short, this is what the bulls are kind of the bears are kind of saying in here. Now let's just kind of discuss the idea of a 5 wave decline that's happening shortly, right? Let's say 1 2 3 4, and then you're saying, okay, fine, you need a wave 5 in here to do maybe some kind of a I don't even know how to look at that because it's not very expanding, right? It doesn't really look as well as this one expands, right? So, this thing would have to be pretty big to kind of create a widening fan in here for a leading diagonal, and then you would get a 3 wave move in here, and then you would have to sell off very sharply, and then you do a 4. So you see what I'm saying? Like, this is already creating a C wave that's way more drawn out, and it takes a longer time. So I don't think that's the case. So in my view, I think that bears need this to happen. Now again, I'm not super happy with the way the 1 2 1 2 is in here, because wave 1, at the next degree, it's a bit longer than this wave 1, and that's not the ideal way of forming a 1 2 1 2. You have a 3 wave move, and then if you're bearish, you're kind of almost wishing that this is the right interpretation. And I'm guilty of that as well when I count bullish stuff. When you see a 3 wave move, you always think about 1 2 1 2 because you want things to explode upwards. Now, if you're super bearish, this is the one, that I think you got to think about. And this is this guy right here, right? Let's say that you finished a 5 wave at multiple degrees of trend, right? So you have a primary, you have a cycle, you have a super cycle, and then you have a grand super cycle. And then you're barely just kind of starting this market. Now, for this, there's a lot of time. You would almost have to, move forward 6 years, right? You're looking at the bear market that would last, multiple years in here, because if that's a 1, that's a 2. Oh my goodness, you got to do a 1 2 in here, and then 3 4 and 5 and 4 and 5 just to complete a wave 1, and then you would have to go up in 2, and then that's the end of the world as we know it, if this is the right count. So again, I don't think that it's the kind of the right way to look at the markets when we know that companies are growing, that I mean, again, there's anything obviously that can happen, and things can deteriorate very fast from if you want to be doom and gloom in the in the world and in the markets, right? So but I see this as a very unlikely scenario. Let's not forget that we have Fed. Let's not forget that we have a monetary stimulus. Let's not forget that they will never let this happen when it comes to the wealth of the United States, right? So besides that discussion, this is kind of the ultra gloom and doom scenario that if you want to really put it on your radar, that's kind of what it is. Now the bulls, which I am at least up into these levels, I still kind of cling to the bullish count because I think the correction finished last year, and we're about to embark in another pretty bullish market here, at least until 2025. They kind of need this to happen, and I'll show you this here, right? So I'm counting this as an ABC. So you have again just your wave 1 decline, you have a wave 2, you have a wave 3, you have a wave 4, and then you have a wave 5, right? So just a decent kind of 5 wave move in here. You can also look, because you have a little bit of an overlap, you can do this in a flat if you want to, ABC, right? So 1 2 3 4 5. This way you don't have overlap between these 2 waves. So that's kind of one way to avoid the overlaps in here, although this was a little bit of a flush. You can also do diagonal in here as well in this decline. Then you go up in B, and then you come down in the C wave. I think this is pretty much undisputable. That is a 5-wave decline. So you do an ABC, and then I've seen other people counting this as a flat. So as a go up in A, down in B, and then up in C. But this move in here, it's a 5-wave move. It cannot really be counted as a B wave. So it's either a wave C, or a wave 5. So that's the end of the wave 2. And then you go from here in a wave 1. And listen, you can still go 1, 2, 1, 2, 3, 4, and 5, 4, and 5. So there's still room for that, because these highs in here have not really been violated just yet. And that's at about 40, I think it's 41.95 that this stop is at. Right? And look at the markets have held the first test of this kind of 42.16. We'll see if they're going to hold into next week. If we're breaking below these levels, up until we're actually breaking this high right here at about 4100, this fourth wave in here can still be a viable interpretation. You can also get a triangle in here, right? This is a 3-wave move. You go, you stop, you go back up, and you do some kind of a triangle. There's room to create a triangle here, because this wave 2 was pretty large. And you say, fine, that's a flat move, and then you go, and you build until, let's say, January, February, March of next year. You're staying bullish, but kind of sideways. Since wouldn't this be funny? Since everybody thinks, oh my goodness, it's bearish, the markets are crashing, the bulls are saying no, we have a 3-wave decline, we're retesting the breakout zone, and we're going to go higher, and instead the markets will just kind of go sideways, pissing everybody off before we resume higher in a 5th wave. So this is also a very kind of decent possibility, decent probability here. So again, I think these levels are very, very important. And then, definitely the 4100. Now, I don't know, because if you break below here, right, you have that argument of a 5-wave decline. And even though you wouldn't be above 4100, you would have a kind of 5-wave move back here. And that would kind of throw a lot of cold water on this kind of bullish. So again, I think we need to hold these levels right here. For kind of the bullish narrative to continue to stay intact. I want to show you, and this is kind of what I think it's going to happen. I don't think we're going to break this that easily. There is deterioration in the number of stocks below the 200-day, below the 150-day, but one ray of sunshine is that we have decent outperformance and let's say relative strength still from the technology sector. I think the financials are still decent in here. I think the yields are in the process of topping and pulling back from 5%. There is different things that I go through kind of through my newsletter and to my daily videos that kind of discuss a little bit of the macro, a little bit of looking at some of the sentiment, put call ratio, right, stuff like that matters in markets. And then also, if you just a brief look, I think I prepared this for you guys. Look at the number of stocks below the 20-day. So we were under 40. We were, I think, almost at 21, 28 or 30 stocks were still above their 20-day moving average in the S&P 500 when we made this low in October 3rd. Here we are making another low below this one, right, on a closing basis in here. And the number of stocks, it's 109, right? So this deterioration, it's maybe a bit led to a little bit the higher caps stocks that are kind of coming lower. But underneath the surface, we're making a higher low in the number of stocks above their 20-day moving average. So this is just a little bit of a pay attention in here. Don't be too bearish when this is happening, when you're coming into support. When you have extreme kind of bearishness out there, talks of, World War III and just multiple fear-mongering accounts out there, and I see some of them out there, right? It's normal, but I would not I would not make a large bet with seasonality coming kind of what it is, that this is about to give you a big crash, um, you know, to the downside in here. So once again, to just kind of review, this is what you need to happen as a bear. A 1-2-1-2 scenario in here, right? If you're ultra, you don't really care. You're just like, hey, 1-2, and then doesn't matter. There's plenty of time. We're going to crash anyway, and we're going to go to 2000 and 1500 in the S&P 500 over the next 6-7 years, right? And if you're bullish, you know, this is a little bit of a pain because it was a beautiful three-wave decline, and right now we're coming to test these lows, and that's not a good development on the bullish side. But I also want to draw your attention to the Nasdaq, right, which is I think a massive index with a lot of great companies in here, and this one, it's got a lot of room to work out. I mean, if this is not a third wave, I don't know what is in Elliott Wave patterns. And if that's a third, that's got to be a fourth. If that's a fourth, we still have a new high coming, and maybe to new all-time highs as a fifth. Now, don't you think that if the Nasdaq moves higher, sideways or higher, the S&P 500 will move lower, right? It ain't going to happen. So think about also the Nasdaq when you're thinking about a 1-2-1-2 scenario. And the 1-2-1-2 in the Nasdaq, I don't know. I mean, you have 38.2% right here. You got even the previous August highs standing up. I don't know if you're going to get that massive break to the downside in here, right? All it could be is just that this wave 4 extends a little bit and becomes ABCX ABC, and instead of a flush, you get more of a drawn-out correction. Now, you got to think about this when you think about the S&P 500 as well. So, yes, things don't look ideal for the bullish case at the moment, but I don't think you could say, sell everything, buy a bunch of puts, and then just retire rich because a huge crash is coming in the market. I would kind of double check those thoughts. So anyway, long video. Hopefully this was helpful in terms of Elliott Wave discussions and kind of the way I look at the market. And hopefully you can pick up a thing or two. But I'm looking forward to your comments and thumbs up and stuff like that. Again, check out my newsletter and see me on Twitter. So I'll talk to you later. Bye bye.